how to manage excessive volatility through smart investments. Well, over the last 2 years, I think the market narrative has largely been about the pandemic. From the March 2020 nosedive, the markets have climbed steadily, and it has been so through most of 2020 and 2021. But interestingly, since January 2022, we have seen an increased volatility in the market. If I'm not wrong, there has been around 6 or 7 times when the markets have actually gone down by 1,000 points. Sensex has gone down by 1,000 points on a single trading day. And interestingly, the markets have also seen an equal number of days when they have gained over 1,000 points on a single trading day. And if you are someone who's been regularly listening to our videos by Dr. Vijay Kumar or Mr. Gaurav Shah, you will know that they have consistently said that this volatility is going to stay for the near term. So what do we do as investors? How do we manage this market volatility? What about our investments? How do we manage our investments smartly through this period of volatility to gain and create wealth over the long term? Well, just to speak on these very same topics today, we have with us Dr. V.K. Vijay Kumar, who is the Chief Investment Strategist at Geojit. We also have Mr. Gaurav Shah, who is the Head Investment Strategist. And we also have this time with us Sriram VKR, who is a Senior Investment Strategist at Geojit. So without wasting much time, I'd like to invite Dr. Vijay Kumar to start off with the webinar. Now, Dr. Vijay Kumar is someone who doesn't need special introduction. I think by just seeing the sheer number of people who join us for our webinars conducted by him, I think he's one of the most sought after speakers and someone whom people like to listen to and learn from. Dr. Vijay Kumar has been with the Geojit since 2010, prior to which he was a professor of economics. And he's someone who writes a lot of articles, conducts a lot of seminars. He's a part of a lot of webinars. And he consistently keeps in touch with all our clients, guiding them throughout as to how they can better their lives with better investments. So over to Dr. Vijay Kumar.
Friends, we are meeting at a time when we are doing this seminar at a time when the markets have turned excessively volatile, and during the last few days, very, very weak. So investors have lots of questions in their minds. I was just glancing over some of the questions which investors have sent, like why this correction? Many are asking, particularly the newbies in the market, those who have started investing in the market during the last 2 years, particularly after the outbreak of the pandemic and the boom that we had in the market. They are surprised by the correction in the market, the sharp correction in the market. Actually, investors know that correction is normal in the market. So the questions that are being asked now are, why this correction now? Why this excessive volatility? How long this volatility will last? Is this the right time to invest? If so, which are the best sectors for investment? And within sectors, which are the ideal stocks to invest? These are the questions. I will not be going into the sectors for investment, stocks to investments, mutual funds. My colleagues Gaurav Shah and Sriram will guide you as far as investments in sectors, stocks, mutual funds, etc. are concerned. I will address the macro part of the economy as well as the broad movements in the market, the volatility in the market, why this volatility, how long this volatility, nobody knows how long it will last, but I will try to give our views regarding that. Now, first we should understand that the ongoing bull run, I still believe that what we are experiencing is a correction in the bull market. So this ongoing bull run, this bull rally started after the crash of March 2020. In March 2020, once the outbreak of the pandemic was declared, it was declared a pandemic and all hell broke loose, the market crashed, and that was a very fast crash and a severe crash. After the March 2020 crash, the market started bouncing slowly in April, May, and then it started gathering momentum. And from the low of 7,611 for Nifty, that was in March 2020, Nifty started going up and touched a high of 18,604 to be exact, 18,600 in October 2021, last year. Now that rally was a very unique rally. I describe it as unique because from my experience in the market for around 35 years, more than 35 years now, I have never witnessed a one-way rally. Such a sharp rally in the market, which was a one-way rally, not just in Dalal Street, in Wall Street also, in the mother market US also, it was more or less a one-way rally without any major correction. Sometimes when the indices double within a short period of time, there will be corrections of 10%, even 15%, but that did not happen at all. From 7611 Nifty to 18,600 Nifty, corrections were conspicuous by their absence. But after October 2021, from the high of 18,600, the markets turned volatile. And this year, in 2022, after the outbreak of the Ukraine war, markets turned excessively volatile with 3% up move in the mother market US. We must understand that globally markets are highly correlated. Whether it is European markets or emerging markets like India, we have been following the broadly the pattern set by the mother market US. And in the mother market US, we had this very strange situation of the index going up by 3% one day, going down by 3% the next day, again going up by 3% on the third day. That kind of volatility also has been very, very rare. And recently we are witnessing, for example, I think this was on Thursday, the Nasdaq corrected by 4.99, 5% correction in one day. So this kind of excessive volatility is a reflection of nervousness in the market. I will come to that. So first we have to understand what were the factors that took the Nifty from 7611 to 18,600. That incredible bull run that we had. It is important to understand that the most important factor responsible for that bull run was the ample liquidity available in the financial system globally. The ample liquidity available in the financial system and the fact that liquidity was cheap. So money was cheap, money was available in ample quantity. Interest rates have crashed to record lows in the developed countries of the world. Fed alone expanded their balance sheet by close to $9 trillion through quantitative easing, that is buying bonds and injecting liquidity. That is what central banks do when you have a recession. That is a typical central bank response. But the consequence of this liquidity stimulus, monetary stimulus, unprecedented monetary stimulus, not just by the Fed alone, by the European Central Bank, by the Bank of England, even by emerging market central banks like the Central Bank of India, there has been huge liquidity creation. So globally, money was available in ample quantity and money was very cheap. And also, fixed income returns were very, very insignificant. Also, it is important to understand that this scenario, when the market started going up, and it started going up steadily, it started going up in a sustained manner without corrections, large number of new investors who entered the market, made a lot of money. Actually, seasoned investors a little bit skeptical. They were not very confident about this sustained rally. But newbie investors, new investors who entered the market after the crash of March 2020, they made a lot of money because the trading was easy. In US alone, 15 million trading apps were downloaded in 1 year. And also in 2021, the total amount of money invested, I'm talking about the US, the mother market. The total amount of money invested in the equity market was $1 trillion, $1 trillion. And that was more than the total amount of money invested in the market during the 20 years before that. So I'm just giving you the figures for you to get an idea about the kind of money that came to the equity markets. In India also, there has been, as you are aware, an explosion in demat accounts. The total number of demat accounts opened in the 2-year period ending March 2022 is almost equivalent to the total number of demat accounts opened in the 20 years before that. So this explosion of demat accounts, this retail investor enthusiasm, that brought a large number of investors, retail investors coming to the market is good. That results in democratization, financialization of savings, even democratization of investment, and actually even an inclusive growth, because the wealth generated through the stock markets gets distributed also in a democratic fashion among large number of investors. That is ideal. That is good. But the sheer number of accounts opened and the sheer number of retail investors who came to the market was actually mind-boggling. It was actually surprising, right? So these were the factors that led to that sharp appreciation in asset prices globally, stock prices globally, whether it is in the US or in Europe or in emerging markets like India. Of course, India outperformed a large number of emerging markets. That's a different story. I will come to that later when we have time. Now, this is the first stage of the bull market from March 2020 to October 2021, when we had a one-way rally. That one-way rally has ended. There is no doubt about that. So the second leg of the rally, second stage of the rally is the ongoing rally, which started in October with ups and downs, with big volatility. And now markets have turned excessively volatile, and recent weeks, in the last 1 month, for instance, last 1 month, Nifty is down almost 8%. Mid-cap Nifty is down more than 8%. Nifty small cap is down more than 12%. So there is a sharp correction in the market. Now, has that made the valuations very attractive? I will come to that point, but let me summarize 3 major headwinds which globally markets are facing now. 3 major negative factors. Number 1 is tightening by the Fed. Fed is the leading central bank of the world, and the Fed's actions impact not just America, the global financial system, the global economy. The Fed thought for a long time that inflation is transient, it is transitory, it can be controlled within a short period of time, but they were proved wrong. They were behind the curve. Now, Fed has categorically stated that inflation is a big problem, and therefore monetary tightening is necessary. They raised the interest rates, the Fed fund rate, by 25 basis points in March. And a few days back on May 4th, they again raised the Fed funds rate by 50 basis points and gave a clear indication, almost clear indication, that in the next 2 meetings also, two stages of a 50 basis point increase in Fed funds rates can be expected. So another 50 basis points increase can be expected in the next 2 Fed meets also. Normally, a Fed tightening cycle lasts for more than 1 year, and the tightening can be 200 to 250 basis points. That is 2 to 2.5 percentage. So that is very much possible. That is very much on the cards. And this kind of tightening is necessary now to contain inflation, but it is not a very positive scenario for equity markets. Globally, it is not a positive scenario, particularly when the global economy is slowing down. When the Fed is raising the rates and the global economy is growing fast, like what happened during 2003 to 2007, Fed raised interest rates, but the global economy was on a song. Growth was very impressive. The scenario is different now. And therefore, you can expect a slowdown in economic growth, a sharp slowdown in global economic growth. Global economy may not fall into a recession. Many people believe that a recession also is possible in 2023. We do not know. We do not know that. We are in uncharted territory. Within a few months, perhaps, or a few weeks, a clearer picture will emerge. So this is the first major headwind which the global markets are facing. Second is China has again gone into a massive lockdown. China has a zero COVID policy. It is a little bit irrational, but they have a zero COVID policy, and lockdowns in China, particularly in Beijing, Shanghai, and the ports in China has disrupted the supply chains, and that is adding to the inflation. Not only in China, it is adding to inflation globally because China is the factory of the world. And thirdly, the third major headwind is the Ukraine war. When the Ukraine war broke out in February, the near consensus was that the war will be over within maximum a few weeks. But now the war is lingering, and it is quite possible that the war may linger longer, much longer than most people expected. So if the war lingers for a longer period of time, crude oil prices, commodity prices, all can remain elevated, adding to the inflation problem that we are facing. So these are the major headwinds for the markets now. I repeat these points. Aggressive monetary tightening by the Fed, lockdowns in China, which is disrupting supply chains, and the Ukraine war, which is pushing commodity prices, particularly crude and metal prices. This is the scenario. It is in this context that we have to look at the markets. And when the US dollar index is now at around 104, and the 10-year US bond yield is above 3% now. I'm a person who believes that the 10-year US bond yield is a very, very important index, perhaps the most important index in the world, because it has implications not only for the bond markets, not only for the equity markets, it has implications for capital flows, it has implications for the currency markets, and therefore it is very, very important. So dollar index at 104 and the 10-year bond yield above 3% is certainly something that has to be closely monitored. It has to be closely monitored. Now, the question is, after this correction that we had during the last 1 month, particularly when the Nifty has corrected close to 8% during the last 1 month, I think, the valuations have come down. So is this the right time to buy? There can be different views regarding that. My personal view is that even now, valuations are not attractive for aggressive buying. Valuations have not turned cheap, even with this correction. If you look at the important indicators of valuations like market cap to GDP, price earning multiple, particularly price to book, all these things are important, but price earning multiple is a crucial indicator of valuations. Whether it is S&P 500 in US or Nifty in India, even now valuations are slightly higher than historical averages. Of course, it has come down from the October highs. Some 6 months back, Nifty was valued at around 23-24 times forward earnings. Now Nifty is at around 19 times forward earnings. Forward earnings means FY23 earnings, around 19 times. And 19 times is not cheap. I won't say it is excessive, but it is not cheap. If it comes down further by, let us say, Nifty comes down by another 5%, which can't be ruled out, then valuations will become aggressive. The valuations will become attractive for very, very aggressive investment. But right now, valuations continue to be slightly higher than long-term averages. Therefore, investors, my own view is, investors need not rush in to buy for making aggressive purchases right now. Of course, long-term investors can buy. Long-term investors can buy at any time. If you're buying good quality stocks in growth industries, in promising industries, and if the valuations are attractive, certainly you can buy. There is no doubt about that. And my friend Sriram will tell you that SIPs can be started at any point of time. SIPs should not be stopped at all. So if you have not started SIPs yet, this is the time to start SIPs. The market corrects further by 5% from here. Well, you can increase the amount of money for your SIPs, the amount of money that you are investing through SIPs, that can be increased. If it is 5,000, you can put it to 7,000, 8,000, 10,000 rupees. So mutual funds certainly continue with the SIPs. I'm not transgressing into Sriram's area. What I'm trying to say is, for an investor now, this is not the time to aggressively buy in the market. You can certainly buy high quality stocks. There are high quality stocks in performing sectors. My friend Gaurang will tell you more about the performing sectors. Which are the performing sectors? Which are the sectors in which earnings visibility is good? And which are the leading stocks there? I leave it to him. So the point that I would like to summarize here is, this is not yet the time. Monday morning or Tuesday, don't rush in to buy aggressively. Time is on your side. We have time available. Take time, make calibrated purchases, not aggressive big purchases. Buy in installments, high quality stocks. Don't go into mid caps which are not yet attractive as far as prices are concerned. Continue with your SIPs, increase the amount of money that you allot for SIP investment. Now over to Gaurang for his take on the markets. He may be having perhaps a slightly different views. We don't agree on every aspect in GF, but generally we have the same strategy. We advise more or less on the same lines as far as investment is concerned. Over to Gaurang.
I am jumping on straight away. I'm not allowing Jyoti to give any formal introductions. I hope you guys don't mind. So I'll just start off because we have paucity of time. It's for 1.5 hours, and after me, my good friend Sriram BKR will take over and talk about mutual funds. So not wasting much time and going on to straight time, I definitely am of the view, and I was just mentioning to VK before we started off this webinar that it is always better to disagree on because that makes a healthy environment and a healthy counter arguments, and that is why we all exist together, because if we agree all, then I think some of us are not necessary. So it was always better to disagree. And having said that, my view on the market is that, of course, not going into the details of 2020 lockdown and then unlock and then pandemic, endemic, etc. But the fact of the matter remains is that on the Sensex, the all-time high that we saw was somewhere close to about 62,200. And on the Nifty, the all-time high was 18,600. From those levels, friends, the correction that we have witnessed in the recent time, the Sensex, as after yesterday's correction, stands at about 54,800 or thereabouts, and the Nifty is at about 16,400 and odd. So in terms of percentage, if you go to see from the highs to the current level where we are, I don't think it is anything serious or meaningful. And whenever there is excess in the market, it is always better to have some amount of sanity and consolidation come in. There are a lot of weak hand leveraged positions that had come into the market, and all those needs to be cleansed off, cleaning, as we call it, sanity returning into the market. And when these kind of corrections come into the market, these weak hands and leveraged positions, they kind of disappear from the market, because all sorts of stop losses and margin requirement get triggered off, and these short-term investors do not have that kind of appetite. Moreover, with the recent run-up in the market as far as the new age IPOs was concerned, that also brought in a lot of sanity, because there was humongous demand for these IPOs, and the rationale of valuation was missing, according to me, because to value these kind of new age unicorn companies, there are no set thumb rules. every analyst has his or her way of evaluating these kind of new age unicorns. So it was good that correction has come into those as well. Overall, friends, I think the markets are poised. I'm not saying that you will not see any correction going forward from here on. There will be correction, but the large part of the bitter pill that we had to bite, I think we have already bitten. Having said that, whether it is the out of turn move by the Reserve Bank of India Honorable Governor to raise interest rates or repo rates by 0.40%, or the CRR rates by or any other kind of rate move that we saw by 0.50%, or it is the Fed moving by 50 basis point. I think all these was factored in. And let me tell you, friends, if the RBI would not have moved in the month of May that we saw last week, then it would have definitely moved in the June credit policy. So it is always better to preempt that. What happens in the June policy, I think the entire talk that revolves around the interest rate hike is purely concentrated on one big factor, and that is inflation. And that has kind of created a little bit of uncomfortable situation and has gone up to a level where it is, above the comfort zone or the elbow room that the MPC or the RBI governor had. And rightly so, moving on earlier rather than later is always a better thing to do. So friends, my sense is that large part of the bitterness or correction that was there in the market is factored in. There may be correction because of certain news flows globally, whatever is happening. The unfortunate geopolitical development in form of Russia and Ukraine has sent a lot of shockwaves across the globe, including India. We are paying the price of rising crude oil prices, and we import close to 80% of our energy requirement in form of petrol, diesel, LPG, kerosene, and other forms. So we will definitely have to pay a price. But on the flip side, we have started importing crude oil from Russia at a discounted price. And the Honorable Foreign Secretary or Foreign Minister, Mr. Lavrov, was in Delhi from Russia. He has further extended a pipeline of crude oil to India at discounted prices. Countering that statement, India has requested Russia to give a further discount for those crude oil supplies. So if we are able to secure our energy requirement, the large part of this, boiling crude oil prices and its impact on the inflation could be a little bit cushioned off. Remains to be seen how the rest of the larger countries look at this kind of a situation, but we made our stand very, very clear. The Honorable Prime Minister, Mr. Narendra Modi, Mr. Jaishankar, our Foreign Secretary, has also made it very, very clear that we will do what is right for the country and for the people of our country. We will not look at any kind of distortions over there, and we will not take any advice that comes in. And in fact, to that extent, Mr. Jaishankar has also mentioned that it is prudent that these countries look at their own supplies that come in from Russia rather than looking at India. So I think it's a very strong stance. It stands very, very confident in terms of what the government has in terms of thought process. In terms of earnings season, what we are witnessing for the fourth quarter last financial year, we saw Reliance Industries deliver numbers yesterday. That was Friday post the market. And whatever numbers we've seen up until now in terms of fourth quarter earnings, I don't think there are too many dark spots. There are a few, but not larger ones or not the ones that can create a concern. The concern might be in terms of the first quarter earnings and second quarter earnings this financial year, given that the larger impact of rising crude oil prices will be felt by manufacturing sectors in this financial year, first and second quarter. So maybe sectorially, FMCG companies, tire manufacturing companies, paint companies, auto sector, auto ancillary sector, and all those sectors which are counter dependent on the crude oil may show a little bit of lag effect in terms of earnings, and maybe the first and the second quarter earnings for this financial year for all these manufacturing sectors which are totally dependent or directly, indirectly dependent on crude oil may have its impact. But I have a contrarian view, and I am always of an opinion that when the larger section of the market forms a single-sided opinion, then the market does not oblige that way, but it does the opposite. And I have seen this many times in the past history, that whenever an opinion is one-sided, the market does the opposite. So I would rather take the position in the opposition and say that I expect some kind of stability to come in the market. Sometime stability in the sense the corrections may not be as deeper as we've seen 800,000 points. And let me tell you, friends, at 54,800, even if you get a correction of 500 points or 1,000 points, in terms of percentage, it is hardly anything. So and so forth for the Nifty. So instead of looking at, oh, there is an 800 point correction, or oh, there is a 1,000 points correction, it is prudent on our part to look at the percentage of correction rather than looking at the point wise correction, and then keep your Sensex and Nifty level in the backdrop and then do a comparison. I think that is a better way to approach the market. And if you look at that, then like I mentioned, from the highs of 62,200 or 18,600, both on the Sensex and Nifty respectively, the markets have corrected marginally according to. And these corrections has brought in a little bit of correction in the valuation. So my sense is, friends, that all the services related sectors should be on your radar. So what are those kind of sectors? Well, there are sectors like IT, there are sectors like banking and finance, insurance, life insurance related companies, telecom service provider companies. These are some of the services related sectors which will not have a very serious impact of rising crude oil prices, and maybe there is a larger cushion that is available. But on the flip side, friends, I would definitely take a contrarian view, and given the price correction and the opportunity that lies going forward in the next couple of years, I think autos, cement, metals, FMCG, including pharma sector, I think these all should be on your radar. Some of the preferences that I would put in terms of sectorial allocation, then specialty chemicals because of China policy, China plus one policy, and the huge change that we've seen in the real estate sector. I think you should not ignore these 6-7 sectors that I've mentioned, primarily keeping large cap in mind and select few mid caps. I'm sure all of you who have joined into this webinar would have your emails registered with us, and you would be getting research reports. So you can definitely open that attachment, have a look at it. Preference should be on these kind of sectors, but a contrarian call on the manufacturing side as well, as I mentioned. And primarily, my friends, people are worried about FI selling because of the Fed stance on the interest rates change. Let me tell you, from last October, FIs have been selling. And if it had not been for the domestic institutions who've been facing the sell-off from the FIs, then I think we would have been much, much lower, maybe 25-30% lower from where we are. But that is not the fact. And the fact of the matter is that the domestic institutions, if they are able to withstand the sell side pressure from the foreign institutional investors, then you can imagine the kind of participation that has been growing. And that's what exactly my good friend VK referred to, that the registration of demat accounts have gone up, registration of account opening with brokers have gone up, and that reflects upon the kind of participation that retail investors are looking at. And more importantly, the data that came out from the Association of Mutual Fund of India, AMFI, I'm sure my friend BKR will also agree to this, and he'll also speak once he comes up to give you an outlook on the mutual fund, that the SIP registration has increased to a great extent, new registrations of SIPs. And let me tell you, friends, yesterday the market fell 800 points. One of the SIPs that I have registered got debited from my bank account. So my humble request to all of you all is, just following up on what Dr. VK said, don't stop your SIPs, keep your SIPs running, keep it alive, and if it is possible, even increase your allocation towards the equity market mutual fund SIPs, because these are great times to nibble into some stock specific ideas. I'm sure in the Q&A session, once it is opened up, I will be helped by Jyoti and her teammates in terms of what are the questions. But just to give you a brief outlook, starting with IT, banking, NBFCs, insurance sector, telecom service providers, auto, cement, metals, FMCG. I think these are some 8 or 9 sectors that you should primarily look at. Look at large cap, and I always mention this, friends, that you should look at quality, don't buy quantity. Don't buy thousands of stocks of a company which you don't know anything about. Just because it is trading at double digit or single digit doesn't mean it is a value investment. There are all possibilities from that, even from those levels, it can go down by another 40, 50, 60%. So buy quality, buy few stocks, but buy quality stocks, which will create a good portfolio for you and will definitely have the goals that you have set in mind getting achieved over a longer period of time. So these are times to buy into it. These are times, and let me give you some more numbers. The last GST number collection that we had was the highest collection, 1.62 lakh crores. I hope I'm right, and on this, my colleague Dr. VK will definitely agree with this. So what this means is that when the GST collections are hitting 1,60,000 crores every month, that means that the government's fiscal balance sheet is becoming stronger and stronger. And let me tell you, friends, I always tell this, addressing this kind of a forum, that foreigners can hate India, but foreigners cannot ignore India. And to your all surprises, friend, just yesterday or day before yesterday, more than a dozen stocks were upgraded by these foreigners, saying that these are value investment. Now, if they are upgrading stocks in Indian stock market, whether it is large cap or mid cap, then it is surprising to see them selling. On one hand, you are upgrading India. On the other hand, you are selling India. So they are contradicting themselves. So I remain extremely positive on the market. My humble request is that these kind of disturbances will come, these kind of corrections will come, which will clean the market, will be cleansing process, as I call it. But if you are a long-term investor, do not lose your focus. Do not lose your investment trading strategy, investment strategy in terms of long-term investment. My only request is that look at quality stocks. Buy these stocks that I have mentioned, 8 or 9 sectors, large cap in mind. Of course, like I mentioned in Q&A, I'll be going into details in terms of what are the stocks, because there are quite a few questions for all of us, Dr. VK, myself and VKR. So I remain positive, and I'm sure that with the normal monsoon, which is again a prediction set aside by the Met Department, 4th or the 5th year, India is going to witness an above normal monsoon. And it's very important for India because large part of our population depends on agri activity. And along with that, friends, we have 140 crore population to feed to. So government is doing the things right. My only humble request is that in these kind of testing times, keep your patience, keep your cool head, have your focus very, very clear, and continue with your SIP, allocate more towards SIP and invest into strong fundamentally sound stock. With this, I will hand over the mic to my colleague Jyoti. And before I hand over, Jyoti, thank you very much, Jyoti, Elizabeth, and the entire team at head office who have put this webinar together and given all of us an opportunity to come and address your concerns. Thank you all very much for being a patient, for patiently listening to me. Hand over the mic to Jyoti and then to VKR. Thank you all very much.
Well, we just listened to Dr. Vijay Kumar and Mr. Gaurang Shah, and both of them have been reiterating that keep your focus, be invested in the market for the long term and invest in quality stocks. As we always say, quality is what matters over quantity. Every time we conduct these webinars, we get questions on mutual funds also, where to invest, whether we should continue investing in volatile markets. And so let's listen into what Sriram has to tell us about how to invest in the volatile market and how to make smart investments and why we should continue with our SIPs, as Dr. VK and Mr. Vijay, Gaurang Shah have been telling us. Over to you, Sriram.
Yeah, thank you, Jyoti, for the nice introduction, and good morning all. I hope Dr. VK and Mr. Gaurang had convincingly covered most aspects of the thoughts around investment. So what I'll do is I'll quickly dwell upon a couple of numbers around the mutual fund. So let me just share my screen. I hope my screen is visible, Jyoti.
Yes, it is visible, Sriram.
Yes.
Okay, thank you, sir. Thank you. Okay. All right. So what I will do is I'll quickly touch upon some numbers around, the mutual fund space. So how was the activities has been in the last financial year, and I will touch upon the SIP part. I have a story for you, and then we will have a small, note around how to position your investments in the mutual fund space, and then we can take the question and answer. So let me first get into the presentation. So financial year 2022 has been having a very mixed response across the mutual fund categories. So let me just take it up one by one. So overall industry had inflows of about 2.46 lakh crores for the FY22, and it is 1.15 times the inflows which we saw in 21, financial year 21. All the open-ended equity, hybrid, others and solution funds reported inflows, net inflows for the whole financial year. Open-ended debt, closed-ended equity and closed-ended debt schemes suffered net outflows. So open-ended debt has been kind of facing a very tumultuous years last year. So we will talk about those numbers actually. So equity category overall attracted inflows of about 1.54 lakh crores, and it turned inflows from outflows in previous year. So in FY21, equity category had net outflows. So it turned net inflows. And also the FY22 inflows has been like twice the inflows we saw in FY20. So undoubtedly, I think FY22 equity category inflows has been phenomenal. And to a great extent that was supported by SIP. I will also mention about that in the coming slides. So this is to give a glimpse of how various equity categories attracted inflows. So by large, in terms of the category-wise contribution, by far I think flexi cap and multi cap had the most inflows been attracted, and followed by sectoral and thematic funds, and so on and so forth. These are all the other equity categories that had inflows. So overall, open-ended equity funds had phenomenal inflows, whereas closed-ended equity funds had net outflows. This is predominantly due to the existing schemes that are getting redeemed or matured as and when they complete the duration for which it was launched. Right. So this has been the scenario of FY22 last financial year. And coming to debt, as I told, it had a very, very nervous year with net outflows at 1.42 lakh crore, and it turned outflows from inflows in the previous year, reverse of what equity had. And debt, ex-liquid and overnight. So within the debt funds, if you remove the liquid and overnight category, still the category suffered net outflows at a higher level. So it has gone up. When you remove a liquid and overnight, the outflows had gone up. It is about 1.67 lakh crore, and it also turned outflows from net inflows in the previous year. And this is the category-wise positions. So this is like, for example, if you have to look at the FY22, most inflows were in money market fund, floater funds, and overnight funds. Liquid still had net outflow, but for them, all other duration funds and instrument-based debt funds had phenomenal outflows. So more or less, I think it has been a very, very challenging year for the overall debt schemes or debt category or fixed income space in the mutual fund as a whole. And understandably, that is possible because for the most of last year, your interest rates have been kind of giving you the signals of being increased, even from the global side and also the domestic space. So on one side, RBI is sticking on to what it was sticking to till the day before yesterday perspective, but then overall things have been pointing towards a hardening of interest rate kind of a scenario, which doesn't bode well for duration funds basically. So some of you investors who are investing into debt funds will agree with me that during this period of interest rate hardening kind of a situation, it need not have to actually go up, but even if the situation is like that, I think most debt funds react negatively because bond prices and interest rates are inversely proportional. They react opposite to each other. So most of the debt funds had that problem, plus there were outflows, so it combined. So this is the view we have on the debt fund at this point of time. Coming to hybrid had net inflows. It turned inflows from outflows in the previous year, and solution had net inflows. And coming to other category, we have about 4 here. So other ETFs had a phenomenal inflows. It went up like 2 times. Index fund was a surprising category last year because among all, this is one category where the inflows tremendously went up. It was about like 10 times the inflows it saw in the previous year. So which means people are more hugging the index, or they are quite kind of understanding how index operates, and they somehow feel index will outperform in the long run. So probably this could be one of the multiple reasons that they could attribute to. And coming to the international fund of fund, again, this had a good amount of inflow. The inflows went up by nearly 1.35 times the inflows of FY21. And this was actually surprising again, because Indians started looking the opportunities outside India. Most of the international funds there were good offerings, plus there were inflows into the existing schemes. So both contributed. If you look at the numbers very closely, both contributed. To a great extent, contribution came from the new offerings. So that was also quite overwhelming for us to understand. People understand the international market. They look for diversifying beyond domestic opportunities. And what is more important point to mention is the limit that was set for the industry in terms of overseas limit got exhausted. So that used to be around $7 billion at the active fund space and direct investment abroad for the mutual fund segment, and that got exhausted. Because of which February 22 and March 22, most of the mutual fund companies would have announced or sent out notice suspending the fresh investments into their schemes. So this happened very recently. There is also a hope that the representations have been made to the central bank and the regulators, respective regulators, and we are hoping, or the industry is generally hoping, that the limit will be hiked. But as of now, there is no news about it. But this happened. So what I'm trying to say is $7 billion limit was there for quite some time, but it got exhausted phenomenally in the last 1.5-2 years. So that's the point. Earlier, it used to be having a float of around $3.5 billion, $4 billion. But the second half got fulfilled in the last 1.5 years. So that's the point. And gold ETF had inflows, but it was not quite like last year. So summary of that is here. So this is something to do with the MF activity of FY22. And as I told, SIP. So if you go by the AMFI data, this is what AMFI data we could see, right? AMFI data, if you go by the AMFI's SIP inflow data and SIP account data, this is what we feel. If I have to summarize that in one word, I would summarize that as India is building wealth sip by sip. This is what we could understand. And let me tell you that this actually talks about the flow from 2019. But even if you take the year back, that is 2018, and see, more or less, I think the inflows have been kind of steady. So prior to 2019, that is 2018, I think the average should be around 5,800 odd crores. And it started off with 8,000 crores, and now today we are at about 12,000 crores. This is what AMFI data is saying, right? And during this period, I'm also trying to compare that with Nifty 500 to give a sense of how the broader markets have been reacting, and post which how the trend has been moving in SIP. Right, you can see a lot of negative events here, negative markets here, and this is the pandemic period, right? March 2020 is the pandemic crash, and subsequently, or prior to that also, you had multiple months when markets were declining. But then still, what we could see is the SIP inflows have kind of been stagnant there, with minor falls here and there, but steadily it went up. Not only that, the SIP active accounts, if you see, it started with about 2.6 crores in 2019 beginning, and today we are close to 5.3 crore. So that shows the kind of participation that is coming into the SIP route. So people like you and me are into this. So if we talk about who are they are people like you and me, right? Today I think they understand market better. They kind of look forward for what is the right thing to do when market becomes very volatile, right? That is, I think we are seeing that trend emerging in the system. But for some of you all who are listening to this and who are kind of looking at still that, markets are coming down. I started SIP very recently, but markets are negative. What should I do? Did I make the right decision or not? Right? For you, I have a story, right? I call this story the plan, the panic, the patience, and the progress. So what is this story? This has a journey of SIP, right? A quick note about it. Let us assume that there is a SIP. This is the plan we have, right? The systematic investment plan. That SIP we started in January 2015. Over the next 5 to 6 years, from January 2015, we had few panics as well. There were market jitters, there were volatility, there were some events, right? So prominent to mention them are 2016 demonetization. And then 2018, you had the market cap consolidations. This is due to a regulatory tweak into the way mutual funds are going to invest in the stocks. right? There was a market cap consolidation, sorry. And then 2020, you had the pandemic. Now let us see how patience helped in the progress of your wealth, right? So, sorry, I have few numbers. Let me take that very slowly for you. This is giving you a glimpse of how various mutual fund categories SIP average CAGR has been for 5 years, 63 months and 72 months. All right. So let me start with this. This is across all categories. So in this screen, you will be able to see how various mutual fund categories have performed during this period. All right. And this covers about 174 schemes. Now, SIP started in January 2015 and we completed 5 years in December 2019. All right. 2015, 2016, 17, 18, 19. 5 years we completed. 174 schemes had a CAGR of 7.7%. 5 year CAGR, my dear friends. Right. This is pre-pandemic. So what happens as of December 2019? We had about 174 schemes and the average CAGR is 7.7%. 97% of the universe was in positive return, which is here. This is the slab of return range or return range slabs, you can call it. And 97% of the universe was positive. That is, they had returns in above zero. That is positive return. Only 12% of the universe had CAGR of above 11%. You could see that somewhere here, right? 12% of the universe only had CAGR above 11%. This is pandemic and lockdown 1. So you are moving this 5-year SIP into 3 another months. So that is about 63 months into SIP. The average SIP CAGR dropped to minus 4.7% with 90% of these schemes going negative. Post unlock 1, that is as of December 2020, if you were to see, that is you completed 6 years in this SIP. The average SIP CAGR improved to 11.2%. 100% of the universe turned positive. Or the same 174 schemes. We are studying the same 174 schemes, how they behave, so as to have a very common understanding. 49% of these schemes had CAGR of more than 11%, which was 12% here. Here, nearly half of the universe turned CAGR beyond 11%, right? Not only that, an additional information, this is the compounding effect we have. See, between this 60 months and 72 months, you completed 5 years here. That means if you are investing a 5,000 SIP, you would have invested about 3 lakh in 60 months. In 72 months, you would have invested about 3.6 lakh. Now see the market value, right? This is 3.63 or 3.64 you can call, and this is 5.05. What is the gain? Here it is 64,000 and here it is 1.45 lakh. So what in effect, what we are trying to understand is, while the invested amount went up by 20%, right? This is 20%. The gains more than doubled. This is the compounding effect. And why this happened? Because the SIPs were continued during the entire drop of the market. When market corrected here, you invested. When market corrected here, you invested. Again, when market corrected here, you invested. So the more you invest and continue your investment patiently, you get the progress that you wanted in your investment, which is the primary motive why you start an SIP. All right. So if markets are coming down and if SIP returns are negative, you have reasons to be happy, because that is the time you are accumulating wonderful units that is going to contribute for your wealth creation. Now we are just showing you some numbers. There are enough numbers to say that, but we are just giving you the most recent major events so that it's green in your memory, you understand it correctly. So net, what we understand is successful investors across the world have more of an edge in their psychology and behavior than in their knowledge in the markets or finance. Please understand this. Your behavior matters, your psychology matters, and that gives you the output in the long run. Now, this brings us to a point, as I told in the beginning also, this question is prevalent in many people's mind. Which MF category I should invest? So just to put it in perspective, today we have about 5 broad MF categories: equity, debt, hybrid, solution, and others. Including the subcategories of each of these 5 categories, the total number of category in India should be around 36 or 37. Which one I should invest, right? Let me give you a simple solution. Maybe this is not the exact solution. This is probably will summarize in consolidated fashion which category are fit for what type of your goal. So let me start with this one. There is a need. So you should go by the need, what you want actually. There is a scheme. Don't go by what is the scheme available and I wanted to invest in that. No, bad idea. You should go by what you actually want and then which scheme will suit that. So you are able to see something in blue here. So these are all the goals I have. Goal planning, capital appreciation, long-term, tax saving. I should be looking at these categories. If I'm a conservative investor, I don't want to take risk and I'm looking for short-term parking, right? I would be looking at these categories. And if I want to do some asset allocation at my portfolio level, I would like to do some passive investing. I would like to put some money in international market. I should be looking at these schemes. So net, goal planning, long-term, these categories. Short-term, less aggressive or conservative investing, these categories. Asset allocation, passive investing, international markets, these kind of categories, right? Now, within equity, you have market cap based, strategy based, sectoral, tax saving. Whether this will suit all the investors? The answer is no. All this will be, or any of these categories one should select based on your personal risk profile and what that permits you to take. So you should actually listen to your risk profiling numbers, right? So your risk profiling number will tell you what is allowed for you, what is not allowed for you. What are your short-term commitments? What are your long-term goals? Based on that, these categories can be selected. Now, I don't have much of time or time or knowledge to discuss such things and take it forward. What should I do? Can I give some or get some simple exposure to a multi-cap kind of a product? Yes, you have answers here. You can simply choose a flexi or a multi-cap kind of a scheme. This will simply expose you to multiple other variants that are sub part of the whole universe of the market cap, right? So I think scheme selection is not that tough. It is not that simple also, I would say, because today stitching a dress for you is actually simple. It is not very difficult, but it is not so simple that you just buy a cloth and cut it into pieces, right? You just go for a measurement at least. So that measurement is important. So I think that measurement is the starting point. That is called asset allocation exercise, risk profiling exercise. We can help you doing it, but for that we need your data. We need to have interaction with you. We need to have appointments with you. Open up with your advisors or the branch executives. They will be able to guide you what is more suited for you. You can also have a balanced approach to the investment. You can also have a solution-oriented investment. Now questions will come. If I want to plan for my retirement, should I choose a retirement fund or can I do it through an equity scheme? My answer is you can also do it through an equity scheme, but retirement plan, children's plan has a name attached to it. So you get an emotional connect. That is the only difference. So beyond this, I don't find any difference between these two. So as I told, as long as you have an edge on your psychology, on your behavior, you might as well do with a core equity scheme, provided this has a balanced approach to your adjusted to your risk profile or the risk appetite. So this is the positioning of the MF investments that we could say. Now, how do you plan your goals? Well, I just thought of adding few inputs as to what and from where you can get such information also. So we have this Geojit Insights magazine with industry news and thoughtful articles. It will definitely help you gain so much knowledge that are very, very relevant for your investment planning. This is a link we have, insights.geojit.com. This is a new link. And in this, we have recommended schemes in equity, hybrid, debt categories. And our research undergoes a very, very strong process. So we have a very, very, clear and strong, very clear and detailedly laid out process. And that has been followed throughout. And it aims to give you the list of funds that's better placed in its category. So that's the whole idea. And it's periodically reviewed as well. Now, in order to execute this, we have a tool that's called Funds Genie. I'll just take a few minutes or less than that to explain you about this. This is 100% paperless account opening. So today you have so much of digital attachment. I think people are more attached to their families and friends and gadgets today. So that's a new entrant in our life. So this is 100% paperless account opening, and your KYC validation is done using the PAN. You can invest in Geojit recommended funds and all top AMC funds through this app. It gives you the portfolio performance tracking, and we also give you the portfolio analyzer. Portfolio analyzer is basically a tool which will help over a period of time to analyze how your portfolio is positioned compared to the peers. And it gives you very, very comprehensive reports. And when you are having a funds in the account, you can still place offline orders through the Geojit customer care team as well. So we have both web and Android versions. So if you are not having the app today, no problem. You can start exploring this through the web link that we have, and slowly you can migrate to app as and when it's convenient to you, and once you decide about it. So with this, I stop here. Thank you so much for your time, and if you have any questions, I can take. Over to you, Jyoti.
Well, thank you, Sriram. Now let's move on to the Q&A session, and I will start with Dr. Vijay Kumar. Sir, we've received quite a few questions, and after sorting them out, here are a few questions that we'd like to ask you. So the first question is how to analyze when we should average the stock at low price or not.
Well, whether we should average or not depends on the stock that you want to average. Now, if a stock is a fundamentally good stock, a high quality stock, there is no problem in averaging. For instance, the stock that you want to average, take the case of ICICI Bank, HDFC Bank, HDFC, TCS, Infosys. These are all high quality stocks, and they have come down. There is absolutely no problem in averaging. You can average. But if you are trying to average a single digit stock or a low grade stock, that would be like, if I may use the cliche, trying to catch a falling knife. When you catch a falling knife, you will bleed. Therefore, don't do that. You can average a high quality stock, and don't average in one go, average on a calibrated basis.
So Mr. TV Joseph wants to know, do you suggest any shift in the investment pattern due to the current steep fall in the share market?
Well, there is a clear pattern now in the market, and that pattern in investment is a preference for value over growth. During this high priced rally that we had in the high priced stocks, which pulled their valuations to a PE of 40, 45, 50, 60, 75, and even more than that in that 2020 April-May to 2021 October rally. Well, valuations got stretched. Right now, what we are finding is there is a preference. Even yesterday, when the market tanked, stocks like ONGC, Coal India, ITC, which are value stocks, were very strong. They actually went up. They did not decline. Right. Therefore, there is a preference for value now. If you are choosing value stocks to invest, the margin of safety is very high. You can again go back to growth stocks when the situation changes. Let me add one more point here, not as an answer to this question, but generally. A very important headwind and an unknown factor for the market now is the Ukraine war. Right? Fed tightening is known, and what is known is always factored in by the market. But what is unknown is the Ukraine war. During a war, anything can happen. There can be a sudden change. Suppose, fortunately, if the war ends because of some reason, we do not know. If the war ends, what you are going to witness is a sharp crash in crude prices. There will be a crash in metal prices also. There will be a decline in edible oil prices. That means inflation will come under control. And if inflation comes under control, well, RBI or the Fed will not be forced to aggressively raise rates as they have planned right now. Therefore, my point is, if the war ends and it is followed by a crash in the crude prices and commodity prices, then you can even aggressively invest in the market. Otherwise, go for investments in a calibrated fashion, not in one go. So that is the answer to your question.
Thank you, sir. And we've always told to invest in quality stocks. Mr. Anup says that he has invested in fundamentally good stocks and they have fallen. So he says he's invested a good portion of his savings into them and he feels trapped. So what should he do now?
Well, if the stocks that has fallen are fundamentally good stocks, as he has mentioned, then he don't have to bother at all, because fundamentally good stocks will always bounce back. The bear market or a weak market will not be there for all time. The market will bounce back after some time when we do not know. So whenever the market bounces back, fundamentally strong shares will bounce back. So you don't have to worry about that. But you have to worry if the stocks that you have invested is not fundamentally sound.
Thank you, sir. Ms. Smita asks, when and how is a good time to make investments into the market? Is it good to borrow money to make investments in the market this year?
Well, the answer to the second part of the question is don't borrow and invest. Don't borrow and invest in the market. Invest in the market only your fund, the funds that you have. The money should come from your savings. Taking a leverage and investing in the market, borrowing and investing in the market is not a smart idea at all. Don't do that. Then, which is the right time to invest? That question has partly been answered by Sriram. I reiterate that point. It is impossible to time the market. From my experience of more than 35 years in the market, I have learned that it's impossible to time the market. Even the gurus of the market say that it is impossible to time the market. Therefore, it is more important that you spend the time in the market, and that is continuous investments, sustained investments in high quality stocks, if you have the expertise to identify those stocks, or investing in a sustained manner through the mutual fund route through systematic investment plans.
Thank you, sir. And I think a few other questions which were asked were like, how long is the volatility going to continue, and when is the market going to stop falling? Why is it falling? I think you've answered all those questions. So with that, I'll wind up the question.
Jyoti, I will repeat this point once again. Yes, when the volatility is going to continue, to what extent the volatility will happen, all these things, the fact that the frank answer is we do not know. But let me tell you one thing. If the market corrects by another 5%, you cannot rule it out, right? If the market corrects by another 5%, I think we will see consolidation in the market and stability in the market. Then you can be a little bit aggressive in the investments.
So I think that will answer most of the questions. So yes, the volatility is going to be there, but just hang on and keep investing. So the next set of questions are from Mr. Gaurang Shah. Thank you, Dr. Vijay Kumar, for answering these questions for us. So Mr. Shah, the first question to you is, which sector to invest, stock specific, in this volatile time with a time horizon of 3 to 4 years?
Great. So what I did in my earlier conversation was that I listed down about 8 or 9 sectors. So what I'll do is I'll try to make a small portfolio over here. I'll pick 2 stocks from each sector that I've mentioned, starting with information technology, that is IT, TCS, and mid-cap stock KPIT Limited. KPIT Technologies, I beg your pardon. So TCS and KPIT would be from IT. From the banking universe, after the results that we've seen of private sector banks, by and large, most of the private sector banks, I'll choose either Axis Bank or an ICICI Bank, and from public sector bank, I would choose State Bank of India. From NBFCs, given the opportunity of price correction and the effect of Q4 numbers, Bajaj Finance and Shriram Transport Finance. This would be the 2 stocks from NBFC sector. From life insurance, well, first of all, a blanket statement or a disclosure. We had given a subscribe to the LIC IPO, so I hope most of the guests who are participating today in the webinar would have taken advantage. If not, then State Bank, SBI Life Insurance and ICICI Pru Life. This would be 2 investment picks from life insurance related sector. From telecom, there are only 2 large players. We don't cover Vodafone, and of course Vodafone is more of a punting bet, so please avoid doing any kind of punting. gambling in the stock market. So Bharti Airtel, and we saw numbers from Jio yesterday. Reliance Industries would be the second. So Bharti Airtel and Reliance Industry would be from telecom service provider space. From autos, one four-wheeler and one two-wheeler, Tata Motors and Bajaj Auto. These would be the two picks from autos. Auto ancillary, I would pick Bharat Forge, and possibly I would pick Sona BLW. Of course, these are broader ideas. Sona BLW we don't cover, but it's a strong company. You can have a look at it. Or else you can look at Mahindra CIE Automotive. I think that's also a good stock to look at. From the metals pack, GSW Steel and Tata Steel. From cement, ACC or Ultratech from the large cap, and from the mid cap you can pick Ramco Cement or JK Lakshmi Cement. So these would be the picks from the cement pack. From FMCG, I would look at Tata Consumer Products and Godrej Consumer Products, and if you want to bet on one large cap, then it would be HUL. Broadly, I think these would be the sectors. I think I would have listed down at least 20-25 odd companies. You can possibly, have a relook at these sectorial allocation that I have made for you, and not necessarily you have to buy all. According to your understanding and your capability of investment of capital, you can pick and choose from this. And I think ideally what you should do would be, what I would do is, pick some stocks, make a basket of maybe 5 or 10 stocks from this entire 20-25 odd stocks, and start doing an SIP. You be your fund manager. Every month, whatever investable amount you have, you can start allocating to these names. And like I mentioned earlier, I think discipline is one of the most important things that should keep it in mind. And remember one thing, markets are exposed to all kind of risk. Equity market is an asset class which is high risk, high return. So please bear this in mind. Jyoti?
So the next question is, I have invested by purchasing TCS shares in a staggered manner over a period of 1.5 years. Please advise the outlook going forward for TCS. Also require your advice on Mindtree, Titan, Pidilite, HCL Tech, as I look to invest in a similar manner over a period of 2 years.
So Mindtree and L&T Infotech, yesterday, Chairman Emeritus Mr. Nayak made an announcement that L&T Infotech and Mindtree are getting merged. It'll take about 9 to 12 months, and the merger ratio, if I'm not mistaken, and if I stand to be corrected if I'm wrong, was I think about 73 or 75 shares of L&T Infotech or 100 shares of Mindtree, and the new merged entity would be called LTI Mindtree. It's a great combination. Bringing in synergies together will make a very strong company. HCL Tech, UPL, and the other stocks that you mentioned are all great companies. You can start getting invested, take opportunity, take advantage of this correction, and start allocating your funds slowly. Not all the investment should be done at one time. Use a staggered manner approach in investing. In TCS, we remain extremely positive, and I think after the numbers and of course the buyback that was there, my sense is that it will be one of the top performing companies in the IT sector. And let me say one thing over here, with the new normal, all of us are using more data and more technology. So if data and technology are so important to us, I don't think IT sector will lag behind in terms of performance. Whether it is globally or locally, I think earnings will improve. And historically speaking, fourth quarter for IT sector is normally a little bit lag one with a little bit of overhang. So don't look at any kind of short-term, medium-term negativities. Look at long-term, and in that view, continue your investment in TCS, and you can increase your allocation towards TCS. Jyoti?
The next question is from Zaid Hussain. He wants to know, what is your outlook for the pharma and healthcare sectors?
So I mentioned life insurance companies, healthcare and pharma. Of course, I did not mention about healthcare and pharma. So in pharma, I would pick Divi's Laboratories and Cipla, along with Sun Pharma. These would be the three preferred names. In healthcare, we cover only one stock, which is Apollo Hospital, which has corrected very sharply. And I think if you get an opportunity closer to 3,000, I think it is trading at 4,000 odd levels yesterday, the last that I saw. I stand to be corrected on that. Closer to 3,800 would be a very comfort zone to invest, to make any kind of new investment in Apollo Hospital. And in case if you invested at higher levels, at those levels, you can consider averaging Apollo Hospital. Jyoti?
The next one is from Meher Raj. He wants to know about stock-specific investments that he's made. Tata Steel, Deepak Nitrate, Asian Paint, Ultratech Cement. The performance of these over the medium to long term. And he's asking for any suggestions for investments which would fetch him around 12% return.
So I think in form of investments, I've given a list of 20, 25 odd companies. You can possibly pick and choose from those names, filter it down, not necessary to buy all. One thing I would like to mention about metals and cement is that the government spending in terms of infrastructure creation in India and modernizing the existing infrastructure, demand for metal and cement will be quite strong as far as the domestic market is concerned. Along with that, friends, there is a huge recovery in the real estate sector, and real estate sector happens to be the second largest consumer of cement and a larger consumer of metals, because you need metal and cement to create any kind of infrastructure. So I am of an opinion that Tata Steel, Ultratech will continue to contribute. Deepak Nitrate is something that we don't cover, but it's a very strong company, let me say this. UPL, again, pharma, an agri play, given the kind of penetration UPL has in the market and the products and the market share, I think it will do extremely well. So all are great names other than Deepak Nitrate, because we don't have a coverage according to the regulation. I can't comment on that, but it's a very strong company, I must say that. But all the other names are great. Stay invested, and if you have investable amount, increase your allocation. Jyoti?
The next one is from Sanjay Seth. He wants to know what is the good amount for buying TCS and Godrej property, and he's looking at an investment horizon of 6 months to 1 year.
You'll have to repeat Godrej Properties and
TCS.
So again, Godrej Properties from the real estate pack is one of the preferred investment idea from our side. As a disclosure, we have a coverage, and along with that, I think we have a coverage on Oberoi Realty as well. So both are great names, strong balance sheet, no debt, no leverage, execution run rate is above the industry standard. And along with that, the realization per square feet is also much, much stronger than the other peers in the same sector. So TCS, I have mentioned at length. I was answering the query earlier. Continue your investment in TCS, and if you're looking to invest in Godrej Properties,